welcome to Investing in Startups. I'm Joe Maker. Join me as we delve into the strategies and stories of some of the leading minds in early stage startup investing. Whether you're a seasoned pro or just dipping your toes into startups, this podcast is your guide to navigating this dynamic ecosystem. Thanks for listening and enjoy the show.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.
Our guest this week is Shawn Merani, founder and managing partner of Parade Ventures. Parade is a pre-seed and seed-focused firm with an affinity for enterprise software. We talked about the state of seed investing, relationships, observing versus predicting, cheating, AI, and a huge win Shawn had recently with the acquisition of Moveworks. Shawn's a sharp guy, and this is a really fun conversation. Please enjoy. Shawn, thanks for coming on the show.
Thanks for having me, Joe.
Why don't we start talking about Moveworks? Parade was early investor in the company, recently got acquired by ServiceNow for almost $3 billion. Would love to hear the background on Parade's investment there and why you didn't try and talk them into getting the full $3 billion instead of the 2.85 that they settled for.
Yeah, no, great question. Actually, not a Parade investment. It's a Flight VC investment, my first fund. Before that, I had met Bhavin when we were both kind of on the operating side. He was at his previous company, Refresh, where he'd raised venture. It was a kind of consumer folio company, built like kind of a LinkedIn folio. Got to know him over that time, had a ton of people in common, grew up in the same area. He was a couple years older than me, so we had just a lot in common and just kind of vibed out the gate. And then after I left LiquidNet, building the private shares platform there and was figuring out what I wanted to do before I started my first venture fund, Flight VC, I was just kind of helping other friends out, helping startups, helping other venture funds, helping some raise money, helping them with deal flow, just like trying to stay busy and figure out where the dots would connect. And like, honestly, what would drive me to figure out what I was passionate about for my next moves? Was it starting a new company or a venture fund or what have you, or even joining a Bhavin? And so we were kicking that around. I was just helping him out and we deepened our relationship. And after that, he ended up pivoting Refresh to a enterprise product, selling it to LinkedIn, and we just kept in touch. He took a sabbatical for a couple of years. I was starting my first venture fund. And we actually, I didn't share this with you earlier, Joe, but we ran into each other at Skydeck at Berkeley. And so I'm a Berkeley alum. He's a UC alum. And we ran into each other there. And he wasn't like pitching. He wasn't there as an investor. He was a photographer. And so he was like, literally, he was trying to learn photography. And so he was at that place, like taking pro bono pictures for them and apprenticing for like the photographer there. And so we reconnected and he's like, hey, I'm thinking about jumping back in. We should talk. And so we got together and he had just linked up with his soon to be co-founder at Moveworks, Vaibhav Navargi. And they had a bunch of ideas they wanted to kind of kick around, and some computer vision, some machine learning, AI driven. And that was Vaibhav's background as a founder before. And they ended up kind of what was the idea of Moveworks. And it was actually, we want to build AI and machine learning for ticketing. And we think ServiceNow at that time was a $10 billion company. And they were like, they are not doing AI. They are not mobile first. They're not doing it right. And we think, we can take out that $10 billion opportunity. Obviously, fast forward to today, ServiceNow is multiples on that. And to your point, ended up buying Moveworks. And so I just had conviction in Bhavin, man. He is a determined guy. He wants to prove everyone wrong. He has the multiple chips on his shoulders. So I just had that founder conviction regardless. And I knew I wanted to work with him. Seeing him and Vaibhav together, that just made it more special. And then when they found this idea, what I also love about Bhavin is when he's not the smartest person in the room, he wants to be the smartest person in the room, and he's going to educate himself to do that. And so I saw him time and time again. And as they were working in the ITSM space, building Moveworks, which was called Banner Tech at the time, was the holding name. That's what we invested in. He was just like talking to all the right people and just trying to really understand the space better than people that have been there for years. He was walking himself in rooms with pilot customers. And Joe, I shared this with you earlier, and I don't think Bhavin will get mad at me for saying this, but he's also in his 40s, but he still looks super young. And when you're selling, 6-7 figure ACV contracts to Fortune 2000 enterprise customers, they want to see a little, grizzled hair and like you've been around and you've built products for enterprise folks. And, he doesn't have that look. And, people do jump to conclusions. He doesn't have that resume. I think they slowly found out that he was the expert in the room. And that's kind of what kind of got them going. And so we ended up raising that first round before they really built kind of anything. And this is before generative AI. This is before all the advancements in AI that we had today. And so you had to actually hire people that were the smartest people to kind of build the foundational models that, Moveworks was built on. And so it was a different time. It was, I don't even remember. I think it was 2016 that we invested. I mean, he came to me and said, Shawn, if you want to invest, like write me a term sheet. And at that time and what we were doing with Flight VC, we weren't really leading and co-leading too much. And I had a partner at the time. And so there's some friction there. And so I ended up writing a smaller check than I would have liked. They raised that round from Lightspeed. RF over there led it. RF and I didn't know each other again. And now we're pretty good friends. And then they subsequently raised Series A, B, C, so on, ultimately getting acquired here by ServiceNow. But it's kind of like went according to plan. I'd say the only thing not according to plan is like Bobbin wanted to take this thing public, and ultimately, he sold it for $2.85 billion, so I think it was pretty good, pretty close. He'll take the win, we'll take the win. And just like really proud of those guys and just like happy to be a part of the journey since the earliest days. And honestly, that was one of the case studies that gave me conviction to build Parade. Is like we get there early, we have high conviction and kind of outlier founders. And, the venture model is like if you own more, it'll drive, more returns for your fund. And that, that's why we run a more concentrated model, investing in 4 to 6 startups a year. And, we want to find the next Moveworks to, drive significant returns for LPs.
You were really ahead of the curve there, 2016. Some might say that was like too early, but obviously given how things worked out, it worked out well enough. How do you think, if we're going to put this in baseball innings terms, where do you think we are on innings with the AI investing cycle?
I don't know, man. I'm not smart enough to answer that question. I also don't like to predict the future too much. I try to live in the now. And I think if you pontificate too much, you can get yourself in trouble. I think we do as venture investors like want to be in areas before they get hot, or people like to use the analogy, skate to where the puck is going to be. But I just try not to get too deep on that kind of stuff. No, I don't know. I think from an investing perspective, like, yeah, it's hypey. It's peaking right now, and it could peak for a long time. I think it is shared amongst everyone that this is like a generational shift, like mobile was, like cloud was. And I think we're early, but it could be a longer period. And I think you have to look at every investment on what is their AI strategy and what are they doing? How are they leveraging AI? But I try not to get too caught up in things like that, in hype cycles. The way we invest is like we try not to like invest in the peak of things and when everything is hot and there's a ton of money flowing into certain areas. But if you think everything has AI, like there are going to be pockets where you can invest. And so I just think we don't want to be competing with firms that are bigger than us. We don't want to get in bidding wars, et cetera. And so we try to stay out of that.
You're pretty fond of enterprise sales, and I would be curious to hear more about that. But what are you hearing as far as feedback from your founders and enterprise customers today and how they're thinking about software?
Software or AI?
Well, I guess they're so close, but we could say AI.
I think they run the gamut. I think everyone's trying to figure out an AI strategy. I think it depends on kind of where they're sitting. We're an enterprise-focused fund. We've been that for a long time. I think most funds out there are now enterprise-focused just because we've been in a consumer lull for a while. I think we were there first and kind of like that was differentiation when I was raising Parade 1 or tentative differentiation. And that's kind of where more money went. And now, multiples are down and things like that. So maybe people are like scrutinizing it and they're saying enterprise is dead or SaaS is dead. People like to speak in hyperbole. My fundamental belief, and I could be wrong, is that people buy software and people buy software from people. People don't buy software from machines. People don't buy software from AI. Maybe there will be sales tools that will aid that process. But if you have people on one end that have budget that are buying software, and you have people that need to articulate and sell that software in the right way, you need a go-to-market motion to get that to make that happen. And everyone has different buying cycles on that end. And so if that exists, enterprise software exists. And so that's kind of my fundamental belief. But if it ends up being AI eats the world, I need to look for another job. Honestly, like I don't know. So I think, like I said, I'll take it step by step. But definitely eyes wide open, ears open, etc.
You wrote an article 5 years ago called "Learnings from Fund 1: Time is Your Best Friend." If you were writing an article today with learnings
I think that was my last article, or maybe I did one more, but I'm not a big writer.
It's been a while. I think it was, you're not a big writer, but if you're going to work on one for learnings from the next fund, what would that be about?
Learnings from Parade too. I think venture is very different. It's very different from when I started in this business. Going back to Moveworks, like Bobbin, even if he went from consumer to enterprise, serial founder, like in the past 5, 6 years, if you are a second time founder, like the multi-stage funds are going to throw you a check. A ton of firms are going to throw you a check. It's going to be a high price. There's not you're going to have leverage in that valuation discussion. We're firm believers that entry point matters, and it does. And that's how you get your ownership. That's how you execute your fund strategy. So my point is, if there's different funds with different objectives, creating kind of a more fluid market, it's just going to move the price up. And I think also it just makes the relationship between founder and investor more transactional. And that's just kind of, in my mind, is where the market has moved. By the way, today in 2025, and what people consider a down economy in venture, because there is a squeeze at Series A and in growth rounds not happening as often, seed is as vibrant as ever. There is a ton of money out here in seed. Deals are getting done super fast. We don't see a slowdown in seed for, really strong entrepreneurs solving, hard, big problems. But we know there's a squeeze ahead. And so that just I think perpetuates the transactional nature of the business. And so that's changed dramatically. To your point, I don't blog, we have ideas, but I think what I've learned over the past 5 years is you just need to double down on what you're good at and what you're passionate about. And I've never been a writer since I was a kid. I did fine at it, but did I love it? So I think you just got to do what you do and do what you love and spend time in that and make that your superpower rather than tweeting. Or if that's not what you do and that's not going to be additive, I kind of am of the belief I don't do it. And so that's why I'm not out there blogging, just because everyone does that. And so, we find our deals, et cetera, but if it's going to be competitive and we're not going to be able to execute our strategy, we might evolve the strategy into still doing some core investments. Maybe we do some smaller investments where we get a little less ownership. I don't know what the answer is, but the ecosystem has changed. I've been telling people it's as crazy and active as it was in 2021. But at least 2021, there were follow-on rounds happening. Now, were they at the right valuations with the good businesses? Let's just separate those two things. But it feels like that time again, But I also see the constraint in the future. And so that's a problem. And so I don't know. I don't know. So those are some learnings. That's what I'm seeing. And I think what I love is the example with Bobbin. I love spending time with founders. I love focusing on the hard problem. I love kicking ideas around. I love building product with them. I love helping them find product market fit. That's what I love about the 0 to 1 stage. Even though we're the first money in and it takes the longest to make money, it is not the best way to make money in life, but it is darn fun and I do love it. And so if it becomes more transactional, it's just less fun for me.
Well, I wanted to ask you about that because I know you're very relationship driven. You like to be very hands-on. How do you find that equilibrium where you're getting enough time where you can be hands-on and early building relationships before you commit with
we're just
the environment and getting deals done?
No, I mean, look, there's still your founders out there, right? I think it's helpful if you take risk in sectors, right? So if you're going to go chase an AI deal with the top PhDs from Stanford or Berkeley, number one, that's just not a playground I should be playing in, because there's those smarter people than me that are working in venture, that have that background, that can talk that talk with those people. They're bigger money, they're bigger firms. It's just not something I should be chasing, number one. I like to take risk. I like to go and get in areas that before they get hot, right? Moveworks, like you were saying, right? Before AI and machine learning and all that was a thing, even though I think a lot of people were investing in it for many years, but now it's a thing, right? But it's how do you get there earlier and take that risk? And we just try to be upfront of what our diligence process is. I think we're trying to make it faster. Just given things are moving, you have to figure out a way to move faster. But it's really hard to move faster and get to know someone and take the time to spend the time with them. So I think there's some happy medium there that we're trying to reach. But just be upfront. This is how we work with founders. We meet them every other week. We are on the board sometimes, a lot of the time. And we think the relationship is important. We want to have really honest conversations with you. We want to help you get from A to B faster. It's really hard to do that if you don't know data and you're not spending the time. you don't have that vulnerability, and you can't have like you're too scared to insult each other or whatever, or have like a hard conversation. Like, we don't want to build up to that. We want to hit the ground running once we make the investment. Of course, you're still feeling each other out, but if you can front load that, I think that also builds conviction for us. There's just so many things I see that are out of founders' control. But if we have high conviction in them, they're going to pivot. They're going to make the adjustments faster, right? And those are the people that we're trying to find. There's going to just be a ton of things thrown their way that are nothing they could have planned for. It could be macro. They could be sector specific. It could be a bad decision that they made, that we all made together. It just wasn't the right decision for whatever reason. It could be a hire. It could be a product decision, right? You're trying to make as little of those mistakes as you can, but we do it together, right? And even if it's the founder's decision or the VCs or pushed it on them, which is a narrative, and I don't like that narrative because we like to be collaborative, and it's like we're all on the same team. But that's a narrative that's out there. Ultimately, a decision is made, and we're all responsible because we're all around the table, right? But I think having an open dialogue to be able to make those decisions and call each other out when you're frustrated, et cetera. It's like a marriage. Like, you have to have good communication channels. So let's establish them early is kind of my philosophy. So yeah, we try to still preach that. Some people like it, some people don't. I mean, it's really hard not to be super transactional when there's a ton of money out there and you can raise at a high valuation. But ultimately, that's not the terminal value of your company. If you raise a pre-seed round at $100 million, which things happen like that too, and you own 25% of it as one of 3 founders, your net worth is not $25 million at that moment in time. It is sexy to say that you are worth $25 million. You know what I mean? So I think it's like, just using that as an extreme example, it's just really hard. It's just a hard decision to make. And I see how people get caught up in it, but you only have a chance at each stage to pick your investors once. You can't do a secondary and get rid of them, in a normal situation. Of course, if you keep growing, people can get secondaries, but its purpose is usually not to swap out your investors because you made a mistake there. You know what I mean? So I just think if you're picking your small tribe and your group of people to work closely with you, you should be thoughtful about it. Just like you're thoughtful when you're dating someone or you're marrying someone, right? Same, right? And this is a harder thing to get out of, I think.
I was going to say, it's probably easier to get divorced than it is to shake off a lead that you don't like.
You can quit, but there's huge opportunity costs with that, right? So I don't know, man. It's just, I'm like, yeah, you should probably be more thoughtful about that. Being transactional does not breed good long-term relationships, in my opinion.
You mentioned LiquidNet before and secondaries. You were the co-founder there, the private shares marketplace back in 2012. Feels like secondaries have reached an inflection point over the past year or two, maybe just because VCs and LPs want DPI, but it feels like everyone's getting more comfortable with secondary. Curious for your thought on where secondaries are today and where you think they're headed.
I don't know. It's always been a problem. We got close to, we built a company of critical mass, and never ended up going past that after we kind of got incubated or raised strategic capital from LiquidNet and built it for them. And then Forge, I think, ended up taking a lot of the things that we were saying. And I think it's a public company, and I don't know how big it is. But I don't think there is a platform at scale to go solve secondaries. So I still think it's an existential problem. And I think it hasn't been solved for a variety of reasons. Separate conversation. Yeah, secondaries I think are normal. I think for us as a seed fund, it's I think it's actually the top form of exit that we should approach. M&A is random, has some level of randomness. IPOs are not happening. Maybe they start to happen again, but expecting a company to be a public company is just an even longer journey. It ties up our capital. So I think the best solution for smaller funds to get DPI within their fund time frame is secondary. Yeah, I think it's totally accepted, especially if the company is doing well and you've been an investor for a long time and you have a good relationship. Again, going back to the relationship with the founder. We've sold secondary in a variety of companies, not in Parade. Parade's pretty young still, right? Especially with the lull of the past few years. But for my previous fund, we've sold secondary, and so yeah, no, I think it's generally accepted. I think it should be more accepted, but I think right now the state of it is what I've seen in our older names is a lot of deep discounts on a lot of companies, and so that just tells and people want to buy up. So I think we're kind of in a low point at those growth rounds from before, from the high times. And people want to buy up in amazing companies. And then a lot of these companies that did raise those growth rounds are going through, that they didn't preserve capital or we're kept their burn high and we're not spending efficiently, there's going to be structural changes with those companies. And some of them we're going to hear about and some of them we're not. But I think secondaries is an interesting point. But usually when like people are buying at a deep discount, it just tells me to like keep holding and hopefully, we can recoup some, if not all of that value from the high point in the near term. But no, I think they're pretty common nowadays, especially in good companies.
You're fond of capital efficiency. Common narrative is startups are getting more capital efficient thanks to AI, or at least could be. But round sizes keep getting larger, which doesn't seem to be swimming in the same direction. How do you think about capital efficiency for this generation of seed stage and where that'll be over time?
Why do you say people don't believe in capital efficiency, just generally?
Well, because there are plenty of investors who love to stuff capital into companies. And I mean, they can say they're fond of capital efficiency and then they'll turn around and walk out a ton of money into an early stage startup. So
I think it's really hard at my stage when I invest to be capital efficient, but I think it's like having a plan. But I think as you crystallize your numbers and understand your sales process and understand kind of what is your long-term ACV and, your pricing. There's too many levers in the early days to like really be truly capital efficient. But I think as you go forward, you can kind of hone in on that, and I think it's capital efficient is the trade-off between growth and cash burn. If everything is true about the AI world, theoretically, like companies should raise way less money. They should be able to jump off the venture treadmill. They should run profitable businesses. Can they get to like revenue run rates and valuations that provide venture returns for like the later stage funds? I don't know. Or does it create more fragmentation in a bunch of sectors around people solving similar problems and a bunch of them, instead of like one getting to 100 million, 10 of them get to 10 million? And what does that mean? I don't know, right? Because I think TBD. But I think, if I invest in the company and it's zero and in 3 or 4 years it gets to 10 million bucks and it's throwing off a few million of cash, there's value there, right? Like, are they a $1 billion company, which is what I try to invest in and hope for? No, but if like my middling companies are doing that and they've only raised a little amount of cash, like could be worse things. But I think I think at every stage you got to look yourself in the mirror and really say is like, can I at least 3x for my next valuation? Hopefully. Really hard to do, by the way. But is this like a 10x company from here when I invest? Because that new investor wants at least a 10x from that point when they invested. But I think it's like who has the most asymmetry around the table in information? It's like, it's not even me, it's the founder, theoretically, if they're truly introspective, they understand their data and they understand their customer and, they are the expert of their business. They should have reasons and conviction on why they can have that kind of outcome. But it turns out if you look at the data, most companies don't have those outcomes, right? So, I think, and like us as investors can kind of give them our feedback on what we think. You can usually see in like the pro rata decisions at, various rounds, like of what the investors really, really think. Like we pass on pro rata. It's like, hey, do we think we have enough exposure here? Or is it a slam dunk that they can, they're ripping so fast that they can get like 10x from here, I think the devil's in the details of that decision making, because usually if it is that hot company, no investor is giving up their pro rata for free. They're not giving up that option.
You've been a lecturer at Cal Berkeley for a long time, roughly a decade. How has the syllabus of what you've been teaching, what you're teaching now, correct me if I'm wrong, new venture finance, how's that syllabus evolved?
Well, I've been teaching for 4 years as the main guy. I was a guest lecturer for another professor who ended up taking over for I think 5 years or something. So yeah, 10 years doing various forms of lecturing. My syllabus hasn't changed in 4 years. I just completed the 4th year doing it. Every year we kind of look at it and say, where should we change? What should we change? What we're really teaching them is like how to be dynamic at each stage of fundraising, with a couple of topics where we go off that path. Like we talk about crypto, when crypto was not as hot as it is right now, back again, right? People weren't interested in it. And they're like, why are you talking about this? Like, and so we thought about ripping it out. Now it's back, right? So it kind of just tells me is like, hey, it's a thing. It's pretty big and it should stay regardless of what. Some years the students are not going to be into it. Some years they're going to be into it. But it's like an important part of our ecosystem. There's a lot of money flowing in and innovation. It's very different. But we're teaching them how to raise capital from like company formation to taking them public, and what are the nuances there and what can they expect. But really, we want to create dynamic thinkers as operators because there's so many, different points of change. It could be sector specific, like it could be macro, it could be business model. But how can you adapt the process that you're running for that time? And how can how can you be smarter about capitalizing your business? And then there's stuff around, we talk about private equity and, cash flow positive businesses and how they're different and how you raise money. We just want to equip these students or pique their interest so they learn more about how to run efficient and capital efficient businesses. And is it using venture or not? We come at it with the tech angle because that's where I come from. That's what I know most. And then we bring in a lot of experts to kind of double down and give them different perspectives in each class. But no, it's a lot of fun. But honestly, the syllabus hasn't changed much. It's a good question, but yeah.
How firm are you about price rounds? Are you a price round only guy? Are you fine with safes? What's your preference?
It really depends. I usually say, like, if it's a larger round, it creates alignment between us and the founders to know who owns what and what the cap table is and start to build structure and create a board. Like, do we have board meetings or not? Like, maybe not. It doesn't really change the cadence on which we meet companies. But I think it's just like setting it up for success. I think notes and safes can get unwieldy, it's really hard to track them all the time if you're adding money here and there and actually know what true dilution is. And so it's just like a good way. It's good hygiene. But if it's like a smaller round or it's this company is like pre-seed and they're not raising much money, like I'm totally down to do a safe. And I don't think it makes sense. And you can just like bake in things that are important for you as a fund with the side letter, especially if you're taking like a more controlled position like we do. But it's a case by case basis. It's usually a conversation. And like if I have trust with the founder, like, and it's something that they're really passionate about, it's like, to me, I think about it as a term, right? And it's like, is it a term that we agree on or not? And why? As long as we can come to some kind of agreement, that's the most important thing, right? It goes back to the communication and the trust. And so it's like really an exercise in that, right? All of these micro negotiations are.
To go back to your teaching, I've seen a few articles recently about students using AI. I'm guessing you've seen them as well. How are you approaching assignments and grading given the rise of AI? I'm getting the impression virtually all college students are leaning into it, which I would too. Makes sense. And I'm not saying it's necessarily nefarious or cheating, but how do you work with that as someone who's trying to judge how your students are performing?
These are all business school students, by the way, MBAs. And so and I've been an MBA, so I'm happy to like shoot shots at MBAs because I'm like, it's like me criticizing myself, you know what I mean? And so I'm like, hey, if you want to be a startup founder, you can't learn faster than just doing and being in the real world. And I'm an MBA and I am in the startup world, but I wish I got going. I wish I started taking risk earlier, but everyone has their own path. And I totally appreciate that. Like if they want to cheat on the assignments, like go for it. Like their only loser is them. So it's like, what are you here for? You're here for your MBA grades. Like I got good grades in my MBA. Does anyone in startup world give a shit? No. So like, I think you're just calibrating for the wrong thing. I actually got an email after the course ended from a student who might hear this or not. And it's like, oh, I got an A-. I'm like, why? And I'm like, dude, A- is great. And who cares? Like, I don't know, man. It's like, as you get older, you learn to like, and you have kids and you learn to prioritize things that matter and things that don't. And you know what doesn't matter? Your grades and your MBA. And if you want to cheat on a course where you're actually trying to learn stuff about being an operator and raising money and running a business, or as a VC, understanding how VCs think, if people want to get into VC, we teach it from an operator perspective, but you can learn like knowing your customer is really important, right? And you want to cheat, like, all right, you're just shortchanging yourself, man. So that's what I believe about your MBA. That's what I believe about life. And like, do a shortcut if you think it's going to benefit you and you're just doing it to get the grade. My course is 2 units, man. So like, I don't know why you're even wasting your time and showing up, honestly. So that's my philosophy on it. But we tell them don't use generative AI. We're going to catch you and all that stuff. But ultimately, like, and by the way, like the other caveat is attendance is important because we bring in guest speakers. So we that's a huge portion of the grade. Participation is super important because we're talking about, like I said, we're trying to create a dynamic student. And so part of being a dynamic student is asking questions, not being afraid to raise your hand. If you don't understand something, maybe you think it's simple or not. And so we try to foster that kind of environment. And then we bring in these awesome speakers who want to be engaged and who come in and take time out of their busy schedules. And these are like amazing folks. And so we want them to be engaged for that too. And so that goes into their grade too. So honestly, like most of the grade separation is from that type of stuff.
I talk to different VCs who use AI for their own purposes, ranging from dabbling a little bit to built pretty deeply into their workflows. Like where are you on the continuum of putting it to work day to day?
I'm trying to build it into my workflows and doing diligence to be able to move faster, like I said, like on where the deals are moving. I wouldn't say I've figured out my new process yet, but I honestly, it's like something I've been spending like trying to hone in the last month or so. Is like, how can I move faster? Not going to leverage these generative AI platforms to help me move faster.
Are you building anything? You're trying to build anything, or are you just using the off the shelf stuff and running with that?
I'm just using the off the shelf stuff. Look, if I have that fundamental belief that I'm investing in people and that's the most important thing, and I don't think any venture firm in Series A and the early stages like ever shortchange and tries to invest in a good business built by a C plus founder, So like if I believe in that, like that is the most important thing, and I don't think generative AI is going to help me solve for that. So I think I want to invest in it to help me move faster on kind of the check your box things. Like, is it like competitive market analysis, et cetera. But I don't, unless you have an idea of how it can help me get to know people and understand their grit and why they're doing things and, why they're going to be an out of this world founder, please educate me. But I don't see a solution out there. It hasn't been pitched to me yet.
I agree on the competitive analysis side. Like it's the most logical thing, and some of the stuff that you need to fill in the picture around that big shops probably throw a couple associates at and have them go talk to expert networks and do like 60 calls and come back and produce something that you could generate with Grok 3 or O3 in 5 minutes time. But on the getting to know people part, yeah, I think that's certainly the harder part, and especially at the stage you're at where you're so focused on relationship building. I mean, one of our portfolio companies built an AI interviewer, and their AI interviewer gets a higher NPS score from candidates than humans, which is interesting. And I do wonder how long it'll be before a venture fund has someone in the form of an AI interviewer doing first meetings, which probably be heretical to you. But I do wonder someone who's trying to massively scale how that'll unfold. Feels like an eventuality. I don't know who wants to stick their neck out and do it first. Maybe do it in a way that makes them seem like they're cool and tech forward rather than just trying to be hyper scalable. But we'll see.
I don't foresee that happening in the next 3 to 4 years and taking over the industry. And honestly, like, I'm not going to be in this for 10 funds, 5 funds, 4 more funds. Like, I mean, I'm getting older. This is going to become a young person's game. I'm just focusing on kind of fund by fund and having a good time and playing to our competitive advantages. And we'll take the changes as they come. We have so far, and we're still standing, and I think making good investments. And so we're going to continue to take that approach.
Have your views on portfolio construction changed over time?
No, I still think you need to own more of the best companies when you get them early. So I think it still leads to running a concentrated portfolio. I think, because a lot of the big seed rounds have become like small Series A's, of old, if that makes sense. Like just like a lot of my counterparts or competitive seed funds, like they're investing in like $4 to $6 million round sizes. Like I'm just not set up to do that given my round size. That's not what I pitched. That's not what I envisioned being my core competency. But I have a lot of friends that, were where I'm at, that have just grown. And that's kind of where seed has gone to. I think we're trying to figure out how to work with them more. We have a ton of relationships there. We collaborate with a lot of those firms. So I still think you can execute a concentrated strategy with a different entry point and a more collaborative mindset out the gate. And so we're trying to figure out how does that fit into our model and what tweaks do we have to make to do that. I kind of alluded to it earlier. So maybe it's not only doing 20 concentrated bets in each fund. And maybe we start with 10 concentrated bets and 10 little less concentrated bets. And you can openly define less concentrated. It could be, let's just call 10% is what we target usually. Let's say sub 10% is the other 10, but we want to get in early. We want to do the same work. We want to be your first call. We want to be a trusted partner. We want to get the asymmetry of information on how our companies are doing so we can make follow-on investment decisions. Then how can we use all of that and the relationship we built and the founder wants to work with us more? How can we build up our ownership? and get to that 10% or to get to that amount that drives significant returns for our portfolio. So that's like fundamentally how we were thinking about it. Or do we make this change or not? I don't know. Right now, we're still able to find, those 4 to 6 companies a year and get our ownership. So we'll see. But I think, I want to work more with my friends and people I've known for 15, 20 years, and we used to operate together. Like, that's part of the fun. And the fact that, they're doing $6 million rounds and I'm doing $3 million rounds, and they look at me as pre-seed and they're like the big seed, and we can't collaborate until my company graduates. Like, that kind of sucks. Just takes a little bit of the fun out of it, especially if you have that people first mentality, not just on founders, but in who you partner with.
Do you have a favorite question you love to probe founders with?
It's like asking them a lot of questions and see how thoughtful they've been about what they've worked on, what they're working on. Like, they need to be obsessive. So I want to know that they're thinking about this 24/7, 365. I'm not saying I don't want them to have a life and a family or whatever, but ultimately building a business is the ultimate sacrifice, and everything kind of is secondary, unfortunately. I know we live in the day and age about work-life balance and mental health, and I love all of those things and I believe in them. But when you start your own business, which I've done and I'm doing and I'm in, venture's different because you have leverage and diversification, and that changes over time. But when you start, and that happens with companies as you hire great people, right? And you get to a different level. But you're taking a risk, and you have even as your company gets bigger, you have a ton of lives that you're responsible for. So it's a different kind of pressure. But I think ultimately things just have to take a back seat. And so I just want to find people that are obsessive. And I think that's consistent if you look at all of the most successful founders, the top companies of every year, they're maniacal. And so we're trying to find people like that, good people like that, people that work with, that we want to work with, that we're ethically and morally aligned with, that's important too. But we want to find people that have that chip on that shoulder, that are grinders and that want to, make a dent.
What's a conventional view in venture that you think is bullshit?
I think one is only a few companies drive the majority of the returns for all venture funds every year. And I'm like, well, I don't know. What if I own 20% of a company that ends up being worth $500 million and I invested in it out of a $25 million fund? That math is pretty freaking good. Then I did 20 investments, and I'm just using numbers, right? It's all about math.
No, directionally, yeah, I agree.
Yeah, it's directionally math. And so I'm so you're saying if the 19 of my 20 other businesses went to zero, and one of them I own 20% of, and I did follow on, and it ends up being worth $500 million, did I do a shitty job? I kind of did exactly what I said I was going to do. I 4x the fund and 3x net and 30% IRR. So I don't know. But I think people say that, and I think it's directionally right. If you're part of those big companies, you have a big outcome, and it makes it a lot easier. But I think it's also why we know ownership kind of drives returns as well.
Well, Shawn, this was really fun conversation. I appreciate you coming on.
Yeah, anytime. Thanks for having me.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai